All right, before we jump into this week's market outlook, for candidates that are going to be registering for the level 2 exam, if you're registering for the August session, keep in mind registration closes May 9th. The early registration is over as of February 1st, so if you scroll down to program costs, you're going to be paying the $1,200. However, if you click down to November, your early registration is May 10th. You got about 4.5 weeks. Actually, that's 5 weeks away, a little over 5 weeks away to register for the November level 2 exam. And at that point, you're only paying the $900. Also on Sunday, April 9th at 6 p.m., I will have an open session on YouTube, again, April 9th at 6 p.m. for level 2. Last week I did a live Ask Me Anything for level 1. This will be for level 2. It'll be Sunday, April the 9th at 6 p.m. Okay, let's head on in to the market outlook. Q1 2023 in the history books. Nasdaq having its best quarter since the second quarter of 2020. And if you contrast what was going on during those two quarters, you have Q1 of 2023 with 2 rate hikes and a Fed that says we've got maybe another one, maybe more, but one for sure left to go. You had a banking crisis and declining earnings. In the second quarter of 2020, you had a Fed that had rates all the way at the zero line, flooding the market with money, and a government that was sending checks to anybody and everybody who moved. And apparently, this quarter was a better environment to buy to buy stocks than it was in the second quarter of 2020 from a much lower level. So we'll try to make sense of what was going on there, and it really has to do with the belief in the path of rates, a belief, I think, which is incorrect. But I do have a couple of screens for the Nasdaq. We'll bring that in because we do have to talk about what happened with the Nasdaq in the first quarter. If you're looking at the screen, you'll notice that it is different. Some of the information that I used to report on the first screen is now gone. It hasn't disappeared. I've just put it on the second screen so that the first screen is not so crowded. So I've just sort of moved things around and bringing in some new information from some sources that I haven't used before. I thought, well, let's introduce you to some new sources of information. Information you can get for free, but that for some of you, especially if you're commodity traders, you might find useful if you're currency traders or commodity traders. So let's look at what happened to rates over the last week. They have all increased, with sanity returning to the 1 month and the 2 month rates. Last week we ended at 4.28, while the Fed funds rate was 4.75 to 5. So it was really pricing in an idea. The whole curve was pricing in the idea that rates are going to have to get cut very soon. The Fed's going to stop and rates are going to get cut. Well, that's slowly beginning to work its way out of investors' minds in the bond market. 4.74, and we're at a range of 4.75 to 5. So that's beginning to look a bit more rational. Whereas our 2-year, 4.06, it was all the way down to 3.76. 4.06 still down 100 basis points in less than a month from the March 8th high of 5.05, and still down 35 basis points from the beginning of the year. In fact, all capital market yields are lower. And there are a lot of credit products that are tied to some risk-free rate plus a spread. And that risk-free rate is either a 5-year or a 10-year, is some capital market rate. So the credit is cheaper for those products that are tied to this from the beginning of the year. I'm not sure how the Fed feels about that, but we will find out as time goes on. Curve inversion, the 2 to the 10 is re-inverting, dropped 20 basis points, now negative 58. Was negative 38 now, negative 58, 270 days there. The 3-month to the 10-year, the more important one, negative 137, 158 days there. The 3-month rate 18 months from now minus a current 3-month rate, negative 172, was negative 190 last week. I'm using 3-month SOFR on the forward curve to get that done. We look at the Fed balance sheet, it dropped $27 billion. If we look at just the SOMA, the open market accounts, dropped 11.3. This is where the balance sheet runoff happens, is in the SOMA account, 11.3 billion. So you had a 27 billion drop in the balance sheet, with 11.3 coming out of balance sheet runoff. So some 16 billion came off from banks showing up saying, hey, can you give me some cash? Can you spare a dime? This runoff came from T-bills and mortgage-backed securities. So the SOMA account's now sitting at 7.822 trillion. Money still flowing into money market accounts. Total money market fund assets increased by another 66 billion, sitting at 5.2 trillion for the week. Retail, 11.5 billion increase. Institutional, 54.49 billion increase as well. Which seems rather odd, is how is it possible for the markets to go up all week last week and still have significant amounts of money flowing into money market accounts? We're going to look at ETF fund flows from QQQ and from SPY, and this is very surprising. I was surprised when I saw the numbers, but the funds flow was negative. Money came out of those ETFs. How is it possible that can go up for a week and money came out and money came into the money market accounts over the course of the week? It just, when I saw those numbers, right away was a head scratcher, thinking, okay, something doesn't make sense here. We're now 31 days away from the next FOMC meeting. It's a long time in markets, more proximate. The March minutes, 10 days away, which is still a long time in markets. Only one speaker this week, Monday and Tuesday, is Cook. She is a member of the Board of Governors, so she is a voting member. But I don't think that anything she says is likely to stall the rally, because she did speak on Friday. And she's balanced. She says, look, inflation is too high, but here's all the promising signs. So this is something I've taken from Friday. So the first paragraph is the hawkish part, and then once we get past the second paragraph, her speech continues on with, but I see plenty of disinflation signs. She starts with, the inflation picture is less favorable than it appeared earlier this year. Part of the encouraging disinflation initially observed in the fourth quarter of last year was revised away, while inflation over the first 2 months of this year came in high. The inflation data shows some persistence. 3, 6, 12-month changes in February prices for the core PCE index, excluding food and energy, are all around 4.5% to 5%. That is the report that came in on Friday. Housing services inflation continues at a rapid monthly clip, contributing much more to inflation than it did before the pandemic. Inflation in non-housing core services, and that's what the Fed is looking at, core services, ex-housing, remains sticky at elevated levels. Even core goods prices rose in January and February after 3 months of declines, highlighting the uneven nature of the disinflationary process. So all of this reads like, because she's a voting member, reads like she's looking at 25 basis points so far for the next meeting. But we still have one jobs report, because this is May 3rd. We won't have the second jobs. We've got an April jobs report, an April CPI, and an April PCE to come in before that meeting. So we'll see what those look like. After this paragraph, she does continue on, but there's plenty of things to be positive about, and a couple of paragraphs of all the things to be positive about. So she is balanced. So it's not as if she's just hawkish. So I don't see anything that she says Monday or Tuesday would be the cause to stall the rally if the rally is going to continue. If there's a pullback Monday or Tuesday, it'll be for other reasons. I wouldn't look for her to save your short positions. June 14th, which is the meeting after May, the probabilities have shifted to the 5.25. 4.75 has got very little weight now. That would be a rate cut. There's still some weight on there, but you call that zero. You're not going to get a rate cut by June 14th unless something really, really breaks. 5%, which means we get 0 in May and 0 in June. Even odds here, 50%, and one rate hike, 46%. That by June we get there, versus 9.4 the week before. So the market is raising yields that we saw on the previous screen. It is raising the probability of 25 basis points at the next meeting, and that probability is showing up in June as well. But no rate increase for June. We don't have a 5.5 on there. 5.5 has got 0%. So there is no probability being priced in that there's anything more than one rate hike, which is consistent with the dot plot from the summary of economic projections. Reverse repo facility up 156 billion for the week, which is quite a bit. But let's remember that the 1 month and the 2 month, as we ended last week, were way below what 1 day SOFR was, which was 4.8. So banks and money market funds, some money market funds can use the reverse repo facility. You can get 4.8, and we did see on the first screen that even more money went into money market funds. Well, that money's got to go somewhere. It can't just sit in cash, so I may as well use the reverse repo facility. So is it just a reflection of more liquidity in the system? Money flowing into money market funds and banks, perhaps saying, you know what, with our available for sale portfolio, why don't we sell some of them? Let's realize the loss because, well, the loss is already showing up on the income statement anyways. Let's realize the loss. This is probably yielding lower than 4.8, and we could just park the money here at 4.8. I also say more liquidity plus tighter credit. I don't know. Could it be that banks, over the course of the week, banks have lent out less, have tightened their credit, and since they lend out less, they need some place to put that extra money that's building up that otherwise would have went out in the form of loans. Could this $156 billion increase over the week represent tighter credit? I don't know. More liquidity for sure, maybe tighter credit. If you look at the 1 month and the 2 month rate, 474, 479, you get 4.8 in the reverse repo. So if you were thinking you're a money market fund, you got all these inflows, 3 weeks of big inflows now, you're saying, well, 4.74 or 4.8. You know, I'll take the 1 day at 4.8 and see if this can increase, because you'll get 1 day SOFR for as long as the Fed keeps rates where they happen to be, so you can always just keep putting it there. Because we do have a shortage here. And I think this shortage will persist until the debt ceiling debacle is fixed, which, well, it's going to be political theater, right? Brinksmanship right up to the very end. It's only April, and you have till June to get that done. But right now, I think you're at the debt ceiling, so the only issuance can be to replace maturing securities from the Treasury, but not to increase the amount of debt. But once the debt ceiling is removed and increased, there'll be a massive amount of supply that is brought onto the market. That might soak up some of the liquidity that is sitting in this facility here. It might, but you know, we got to start thinking about what is going to happen for June. You know, is there going to be one or two that want to make political hay out of this and are just going to stick to their guns and not increase the debt ceiling and cause a crisis? As each day goes by and you don't have a resolution, you actually have to start to think about that. But the markets are very funny. You could say to the markets, look way off in the distance there. I think I see some hope, and the markets will go up. And you could say, look over here, and I see some fear. And the markets will say, somebody will fix it before it happens. So you can have a whisper of a hope, and that will drive markets up. You can have the reality of a fear, a looming fear, and the market won't do anything until the fear actually shows up. And this is why it's kind of frustrating being short, because the bad news actually has to show up. But for markets to go up, a whisper of hope is good enough, which is why markets tend to do this, but do this. Escalator up, elevators down, elevator down, because they don't anticipate the fear. They think, oh, well, somebody will fix it before it happens, but no one will take away our hope. For real rates, this I found odd. I had to keep checking to make sure that I was, in fact, getting the right numbers. Almost no change week over week. For the ones that did change, almost nothing. And inflation expectations, look where they are now. In fact, if we look at the 5-year, 2.4 is higher than at the beginning of the year. 2.38 is higher than at the beginning of the year on the 7-year, and 2.32 is higher than the beginning of the year on the 10-year. So inflation expectations moving up, real rates not budging, nominal rates increasing. I don't know if I can read anything into that, but see if it follows through for another week. Fed funds futures is reflecting what we saw in Treasury yields. Last week we bottomed out in May at 95.14 for an implied rate of 4.86, all the way to 95.995, or a rate of 4.005 for December, a drop of 85.5 basis points. We're still bottoming out in May at 95.06. That's 4.94, so it is up 8 basis points, but this is the bigger move here. Is December is at 95.59, a rate of 4.41. If we go from May to December, it's a drop of 53 basis points versus a drop of 85 basis points. So rather than having a curve that looked like this, it's starting to come down. And if we go out to March of next year, 2024, 95.885, which is 4.115. The move in the December Fed funds futures was a 40 basis point increase from ending this December at 4% to 4.41%, but still looking at rate cuts over 2024 using 1 month SOFR, December 2024 versus December 2023, 3.12 and 4.42 is down 130 basis points. So the combination of the two is 185 basis points, which is either 7 or 8 interest rate cuts by the end of 2024. The Fed is not signaling that at all, so I think that this curve is going to continue to start to come down again. Let's look at TLT. Down 0.33% for the week, basically flat. SPY was up 3.45%. I made no changes to my TLT position. Implied volatility dropping away really quickly. 13-week implied volatility down in the 29th percentile from the 89th percentile. So over the week, it dropped significantly. My 102 April put is sitting at 44 cents. I paid 202. So not bad so far. That really takes a big chunk off of what I paid for the 110. So I'm almost to the point where, maybe another month or two, I got those free, which will be nice. I've still sold the 115 calls. I'm gonna roll the 102s to the 104s from April to May. This is sitting at 179, so it's a pickup of $1.34. That is due to the low implied volatility. Earlier in the week, it was a pickup of almost $1.78, but I thought I would wait, just give it some time, and I thought I'd continue to keep the $1.78, but just capture more of the of theta on the Aprils. But volatility dropped significantly on these, so now the pickup is only $1.34. Not a big fan of that. I would have rather had $1.78, but we will see what happens over the course of the week. But if I can see the pickup on the premium increase to 155, 160, I'd probably take it at that point. Corporate spreads, the OAS, all coming in for the week, and that would be consistent with the growing consensus out there that the banking crisis we saw was a liquidity issue that has been solved, a asset liability mismatch, and it wasn't a credit crisis. So if it wasn't a credit crisis, why are we making credit cheaper? Let's get credit a little bit more expensive, push those yields lower. 6-month T-bill 4.94, 1 year T-bill 4.64, and the 1 to 3 year investment grade bucket at 5.41, which is 77 basis points above the 1 year versus 80 last week. So that spread is holding its own. Let's look at issuance. This is January and February for corporate credit. If you draw that back, you got to go all the way back to last March to hit those levels of issuance. In February, investment grade 156 billion issued, high yield almost 14 billion, and convertible was $1 billion. In January, 145 billion of investment grade, almost 22 billion of high yield. So total issuance for January and February, 338 billion, up 21% year over year. And I think that is reflecting two things. You have strong balance sheets. Most of the issuance is investment grade. Investment grade has strong balance sheets, and there's yield. Finally, there's yield. So there is a bigger market, I think, for corporate credits, especially in the investment grade, simply because you are actually getting some yield. A large part of that yield, mind you, is the risk-free rate. Not so much a large part of it being the spread, a large part being the risk-free rate, but still, it is still offering a premium. If we look at the investment grade as a whole category, it is offering a premium of 146 basis points over the risk-free rate. So being that there is return in there, there's probably a greater demand for those bonds. If there wasn't demand, there wouldn't be issuance, right? Trading, 47.2 billion average daily volume, up 20% year over year, and the total debt outstanding is now up 1.4%. Next update for March, sometime in the first week of April, SIFMA will have the issuance upgraded for March. We'll get March on the end here. Last March was huge. That's going to be a big comp to beat. Mortgage rates 6.32, still coming down again, another 10 basis points down, and this really helped the spread this week. The 10-year Treasury Thursday over Thursday was up 17 basis points. Yields are coming back into the Treasury curve. 30-year fixed rate down 10, so the spread decreased 27 basis points. That showed up in agency. Agency for the week was up 2.96%. Annually was up 0.95%. Remember, these are spread sensitive because they hedge out the risk-free component to the MBS, and then they lever up the spread. Look at your housing stocks for the week. D.R. Horton up 0.78%. Lennar adding another 1.32. Toll Brothers 2.76. Pulte 2.86. KB Homes after a monster week the week before, giving back very little, 0.57%. Year to date, these things are on fire. In fact, these over here, other than D.R. Horton, these beat the Nasdaq. The Nasdaq had the best quarter since the second quarter of 2020, and the housing stocks in the first quarter beat that index, which had the best performance since 2020. Lennar up almost 16.5%. Toll Brothers up over 20%, Pulte 28%, KB Homes 26% since the beginning of the year. And that's not counting where they came from the October lows to the end of 2023. They have been absolute winners. I just don't know in this environment how much more upside they have. I've said several times, I'm not bearish on the housing stocks, but it's hard to be bullish after 2 quarters of wicked gains in the housing stock sector. It's hard to be bullish. This is U.S. MBS issuance Look at this, it's just dropping off significantly. So higher interest rates have really hit issuance of MBS because, well, what backs MBS? Mortgages. You actually have to have mortgages to issue a mortgage-backed security. So, when you have this kind of trend coming down and you have housing stocks that have just gone up, it's hard to see where further upside is going to come from unless unless mortgage issuance and housing sales really start to roar ahead. I just am not feeling that this is the environment for it. I think they're going to continue to perform in line from where they are now. Again, I'm not bearish. I can't see another 20% upside over the next quarter. Even 10% upside, I don't think I'll see over the next quarter. Housing price index up 0.2 in January. Case-Shiller negative 0.6. This tends to be the more comprehensive one. Case-Shiller negative 0.6 in January, 2.5% year over year. That's not much of a give back, 0.6%. And I think the big problem here is the shortage is going to keep levels elevated. They're just not going to come down. I think levels will stay pretty much in the neighborhood where they are. The rate of increase from those levels, I think, is going to moderate, but the levels will stay elevated. And because the levels will stay elevated when we get to the jobs category, this tells me that I don't know that wage gains are going to go back down to the 3 to 3.5%. And I'll make my case when we get there. Mortgage applications, 4 weeks in a row now, they've been up 2.9%. Refis up 4.8%. Purchase up 2%. Pending home sales down 21.1% in February. Year over year, still up, but not much, 0.8%. The strength that we've seen in the housing market really reflects the inventory levels. And in Canada, it is far worse than it is in the US. So when I see titles of housing crash coming, 20%, 30% downside, I got a hard time understanding how that's going to happen when you have at least all the apartment REITs I've looked at sitting at 97, 98, 99% occupancy. And Canada last year had 1 million immigrants come in, and over this year we expect another 1 million. Where are they going to go? I mean, explain to me how you can have housing crash 20 to 30% when the demand for housing far exceeds the supply, and you have more people coming in every single day. How I don't have the numbers to get there. The U.S. had about the same level of immigration as Canada had, although the population of the U.S. is 9 times larger than Canada. So you can just imagine the stress that's putting on the Canadian housing market. There are, I went online just to look at housing prices and apartment rents just in my neighborhood, and housing prices, yeah, they're lower than they were at the froth of the market last January, but not to the point where you'd say, oh, wow, I really should have waited. You look at the prices now, you still say, well, yeah, but that's still a ridiculous price to pay. There's nothing for sale in my crescent. So there's a main street, and then there's this crescent that I live on. I'm right here, by the way. And there's a house over here. It's just a ranch, 3-bedroom ranch, 1.4. 1.4. You look at that, you say, okay, that's ridiculous. 1.4. Well, when you look around at what else is being listed, even in the bad part of town where you do not want to live, you're 450 to 500. You start looking at rents, even in the bad part of town where you do not want to live, rents are anywhere from 1,400 to 2,200, depending on what you're getting, whether you're getting a bachelor apartment or a 2-bedroom. So I think about that. Let's say you're living in a bachelor apartment for $1,400 a month. You're roughly about $17,000 a year. And if you are living in the bad part of town in a bachelor apartment, you're not working in high finance. You're not a doctor, lawyer, or chiropractor. Well, chiropractor, let's cross them off. They're just like technical analysts. They're just a fraud. But you're not at the top of your game. So you're probably working a minimum wage job somewhere because, well, you're living in the bad part of town in the cheapest apartment you can find. Well, let's say you're making $20 an hour, so you're at $40K a year. This is just an idea of how unaffordable things are. $20 an hour is well above minimum wage in Ontario. You're making 40. You're probably walking home with maybe let's call it 33. Let's say you have the very low tax on that. You're walking home with 33. I'm being generous here, and your rent is 17. That's not including any utilities or food yet. That's just the pay to rent. You don't even have a bedroom. That's just a bachelor apartment at 14. You're well over 50% of your income. So if we can't see how housing costs are going to come down, how can wages possibly come down? How can wage growth possibly get lowered? If anything, wage growth has to accelerate significantly just to keep up with where housing happens to be. And if the Fed is saying that the core services ex housing is really wage driven, how do you solve the wage inflation problem without solving the housing level problem? Not the housing inflation problem. We're seeing that we do have it coming down 0.6 in January. Still, it's up 2.5% year over year. It's the level. You're at 1,400. Okay, great. It's only going to increase 2.5% a year, but still it's at 1,400. You haven't even put utilities on or food, and food prices are, not what they were 3 years ago. They are elevated. I go to the grocery store and I look at some of the prices. Sometimes I think, oh wow, like I can get this, sure, but I mean, how are these other people? This person right here making $40,000 a year. How is this person doing it? They can't be eating well, which then causes a whole bunch of other problems as well. But in Canada, especially, this idea that 20-30% downside, I don't have the numbers for that in how you're going to make that work. And if this does not change, how is this going to stay at 40? You're well over 50% of your income just for your rent, and you haven't even layered on utilities, and you haven't even layered on food. Once you get to that point, you're probably 75-80% of your income in just those categories. Forget a car, forget insurance, forget cable, forget internet. Forget all that stuff unless you take a second job, which probably that's what they're doing just to make ends meet. But how are they ever going to get ahead? So I think you have huge social underlying pressure here on wages that are going to have to start showing up. And when we look at third quarter GDP, we're going to see that there is a shift, or has been a shift now for 2 quarters, a shift from corporate profitability to wages. And I have mentioned this before. If we look at corporate earnings as a share of GDP, typically it has a mean reverting level of around 6%, but for the last little while, it's been hovering up around 10 to 12%. Well, I've made the case before. Is that a new mean reverting level, or are we going to revert back to the 6%? If we think we're going to revert back to the 6%, earnings estimates are too high. If this is a tension that has to be resolved, I can't see it being resolved with housing when you have, especially in Canada, when you have the pace of immigration coming in at a rate faster than you can build. In the U.S., it doesn't really have that problem, but you still have, if you don't have immigration, you're not going to have a growing growing labor pool that will keep wages down. But if you did have a growing labor pool, because of increased immigration to keep wages down, you would only push housing up. It's a difficult spot to be in right now. Okay, we get jobs reports this week. Canada gets it on Thursday because Friday is a holiday. It's Good Friday. But the U.S. is still releasing it on Friday. Markets will be closed, so we're not going to see the impact of that jobs report. but perhaps the Canadian jobs report might have some influence on what we'd expect to see in the U.S. I don't expect there to be job losses. I expect the March jobs report to show gains. If we look at initial jobless claims last week for the week ending on the 25th, 198,000. Or sorry, for the number report on the 25th. The week ending the 25th, 198,000. The week before, 191, 192, 212. And if you just take a quick 275 minus X being each of the observations, the sum of this over 4 weeks, I get to an estimate of 307,000 jobs being added when it's reported on Friday, that we should see 307,000 or around the 300,000 mark. Yeah, it's just a rough estimate. Based on, if you had 275 in initial jobless claims each week, you'd get to possibly 0 jobs added. There is a belief that you need 275,000 jobs if initial claims are 275 per week, you would have no job creation. So that's why I use the 275 minus X to get to 307. Let's see how close that is. It's just a very simple back-of-the-envelope calculation you could do without thinking a lot. It is a big week for labor. Tuesday, we get the JOLTS report. Here is job openings here, and here is quits, the quits rate. Job openings peaked at 12 million, sitting at 10.8 from the last report, which is 6.5% of the labor force. There are enough job openings to fill 6.5% of the labor force, and we're sitting at, 3.6% unemployment. And if you look at the quits rate, it peaked at 3%, sitting at 2.5% of the labor force right now, and it was the first print under 4 million. We're finally back under the 4 million mark. This is 4 million over here. It was the first one under 4 million for quite some time. January was less than 4 million. Friday we get the, Wednesday ADP, the always wrong ADP, but somehow the market seems to want to pick up on it, even though it's always wrong. It's been known as the always wrong ADP for as long as I've been doing this now, well over 20 years. It's always been it's known as the always wrong ADP. You'd think if you were wrong that long, you'd simply just stop. I don't know why they don't just call themselves something else, an alternative measure of something instead of a predictor of what the jobs report would be. Thursday, initial claims again. Friday, you get in the U.S., you get the jobs report. Thursday in Canada, you get the jobs report. Average hourly earnings. This is not a good measure of wage inflation because this has within it not only changes in wages, but also the mix of the type of people who are getting jobs. So it's really, when you look at it, if it's come down, you have to look at why. And if it's come down because a lot of high school or less than high school educated people got jobs and it was primarily part-time, well, that's the mix in there, right? But it's still looked at. January was 4.362%. February was 4.61%. So we could see that it actually increased going into February. This is for all employees, by the way, so question mark for March. If you take out supervisors and managers, these are the hourly, went from 5.24 to 5.33. So it actually, increased. It actually increased, not a narrow down, increased over February over January. So I'm sure that'll be looked at, even though it's a messy number, because it messes up it messes up not only just the increase, if there is an increase in what is being paid, it also messes up the mix of employees in there. The best one for just employment cost is ECI. We get that at the end of April. It's a quarterly. So we'll get Q1 at the end of April, so we're not going to see that for some time. Okay, let's look at some currencies over the week, and we'll combine that with some COT data. This is commitment of traders, and when you get this data, it's from the CFTC. It has columns for dealers, for institutions, leverage funds, and others. And this is all we're showing here is we'll show the institutional side only. The dealer side, there's no information there because the dealer's really just taking the other side of a position if they're making markets. For leveraged funds, they're just hedging. So let's say that you put money into a fund that's holding Mexican equities, but it has its return in US dollars, so that all you're doing is earning the return on the US equities without the currency messing you up. They'll hedge out and move back into the US dollar with their hedges, so they'll sell the peso and buy the US dollar in their hedges. So there's no informational content there either. So the only columns I have up here are for the asset manager, changes in positioning for asset manager or the institutional side. Let's start with the spot market, which we have in the chart up here. And the direction of the return, when we look at the return, is attributed to the first of the pair. So the top performer up here is the US yen. That means the US is up 1.58% against the yen. So if you were long the yen, it didn't work out for you last week. The yen dropped against the US. The next one is the British pound, up 0.82 against the US dollar, and the euro is up 0.75 against the US dollar. And down here we have the Canadian and the Mexican. And you just look at the first of the pair. Here's the US. The US is down 1.59 against the Canadian, and the US is down 2.19 against the Mexican. Again, the Mexican continues to outperform the US when the US is strong. Best weekly performer versus the US. CAD was second. Can we get any kind of information based on what asset managers on the institutional side are doing? Well, some believe we can. So there is something called the commitment of traders. Here's the long, the short, and the spreading. So we'll just cross that out. We just have to look at long and short. And this has changed week over week, and this is the week ending March 28th. That's what we have data for, so we got to work with that. Long positions have increased by 890 contracts to 19,800. This represents 11.2% of the open interest. Here's the big move. Short contracts have decreased 1,800 down to 87,342. That represents almost 50% of the open interest. It is that big drop in the short positioning, which has been attributed to the strength of the Canadian over the past week. So being that long positions have increased, short positions have decreased, both of those are pointing to bullish sentiment. I say sentiment because these are futures, not spot. In the spot market, what moves the currency is actual trading in the currency, either for capital or trade flows. So capital flows is I take my Canadian dollars, I sell them, I buy Mexican pesos, and I buy a Mexican government bond. That's a capital flow. That has to have some kind of spot market transaction for me to buy the Mexican peso. And really what drives capital flows are interest rate differentials between two currencies, or the expectation of either narrowing or widening interest rate differentials. Trade flows, very slow adjustments here, but trade flows happen all the time. I'm in Canada and I have a grocery store, let's say, and I sell avocados. And I get them from a supplier in Mexico. So I import these avocados. I sell my Canadian dollars to buy US dollars. I pay the Mexican supplier in US dollars because trade is usually conducted in US dollars. They then sell those US dollars to buy Mexican pesos. So a lot of the spot transactions that happen on a day-to-day basis are either the result of trade flows or capital flows. Whereas the CFTC data here are futures contracts, which may eventually result in a spot transaction when they settle, that there is some buying and selling of the currency, but this is really just showing changes in positioning, which I'm just calling sentiment. So right now, the Canadian has bullish sentiment. If we look at the yen, long positions have increased over the week. Let's see if I can find a pen that is writing on this. What screen am I on here? Where are we here? There we go. Long positions have increased, but short positions have also increased as well. So I say, well, that's kind of neutral, because you have some asset managers positioning more long and some positioning more short. Long, the 72,000 here represents open interest of 42.8%, and the 56 is short interest of 33%. The peso, bullish here. Long positions have increased almost 6,000 contracts. Short positions have decreased, but look at the big difference between long and short. Short positions only represent 3.3% of the open interest, almost pushing up to 70% of the open interest is long. Leveraged funds are 31.7% of the short interest. Well, that would make sense. If you're in a fund that's holding Mexican assets and it's hedging back to its domestic currency, it would be selling, it would be on the short side of whatever contract it is. Again, no informational content there in terms of sentiment. That's purely an operational issue. So bullish sentiment on the peso over here. And of course, there's the US and the peso last week showing gains, and both of them showing bullish sentiment. If we look at the British pound, long positions have increased, short positions have decreased over the week. That is bullish. Same with the euro. Long positions have increased, short positions have decreased. Again, bullish. If we look at long positions here, 66% of the open interest are from asset managers of the institutional side. If we look at dealers' short open interest, it's 68.4%. So that's why I say there's not much information in the dealers as well, because somebody has to be on the other side of this 66%. So the dealer is really just, again, this is more of an operational thing, no information content. The information content really comes from one category, which is just the asset manager. So it's only worth looking at that column. Bullish on the repositioning of what they're doing in the futures market as well. Okay, before we get to both the Nasdaq and the SPY charts and some narration there, let's look at some of the economic data from the week. This is the most recent view for GDP, fourth quarter for the year. This is the third estimate. Let's just scroll down here to corporate profits. This is important. Real gross domestic income decreased 1.1% in the fourth quarter. There are two broad ways to measure GDP. You can measure gross domestic income or gross domestic product, because there is an identity in economics that national income or gross domestic income equals gross domestic product equals output. So there's that identity. I'm not going to get into the academics of it, but there is that identity. So gross domestic income is just another way to measure GDP. Decreased 1.1% in the fourth quarter, in contrast to an increase of 2.8% in the third quarter. The average of real GDP and real GDI. Since you have two ways to measure it, one thing you can do, and we did this for the first quarter of 2022 in one of the outlooks like a year ago, where, real GDP was negative, but real GDI was positive. When you took the average of them, you did not have a recession. Well, this is all they're doing, is just taking a weighted, when you take an average, it's just a weighting of 50% on each one. The average of real GDP and real GDI, a supplemental measure of U.S. economic activity that equally weights GDP and GDI, increased 0.7% in the fourth quarter, compared with an increase of 3% in the third quarter. So 0.7. Let's go down to the table down here. Real GDP, third estimate, 2.6. We had 2.9, dropped to 2.7. Now it's 2.6, because you get better data as time goes on. You get revisions to previous data series, so it allows you to get a better estimate. 2.6. There's real GDI, negative 1.1. So when we average them, you get the 0.7 is probably a more accurate measure of what growth was in the fourth quarter, 0.7. This here, profits from current production. This is corporate profits with inventory valuation and capital consumption adjustments. Corporate profits decreased $60.5 billion in the fourth quarter, compared with a decrease of $1.3 billion in the third quarter. Third quarter, decrease of 1.3. Fourth quarter, decrease of 60.5. an acceleration in the decrease. And what have we seen with the forward estimates from January 1st? They have consistently been dropping every single week. Profits of domestic financial corporations decreased $59 billion in the fourth quarter, compared with a decrease of $1.8 billion in the third quarter. Profits of domestic non-financial corporations decreased $22.9 billion, in contrast to an increase of $16.1 billion. So we are seeing an acceleration in the decrease in corporate profits. However, if we look at real personal incomes, this is corporate profits. And as I explained before, the corporate profits as a percentage of GDP, sitting around 11-12%, have never been higher. And that has come at the expense of employees. Well, let's look at personal incomes. Current dollar personal income increased 398, almost 400 billion in the fourth quarter, an upward revision of 10.8 billion. And the last line is, we'll go with disposable. Disposable personal income increased 403 billion, or 8.9%. Real disposable personal income increased 5%, an upward revision of 0.2 percentage points. So current dollar personal incomes, disposable personal incomes, and real disposable personal incomes are increasing. Corporate profits are decreasing. This is a wealth transfer, or an income transfer at least, from corporate profits to the employees. I don't know that this reverses itself. I don't know that this slows down, simply because you have the tension between how much of your personal disposable income is spent on housing versus what you get paid. There is that tension in there where something has to break. Either the level prices of housing have to come down, which means you need actual deflation in housing, not just disinflation in the cost of housing, or you need much more rapid increase in wages, being that corporations have moved away from the 6% mean reverting level of corporate profits to GDP to almost double that, 12%. It seems to me there's room in corporate profits that are going to be squeezed to correct that tension between the returns to labor and the cost of housing. How else can that be resolved? It's going to have to be resolved. So are we potentially facing a return to the mean reverting level of 6% corporate profits? If we do, from 12% to 6%, that is cut in half. Now, I don't know that we get back to 6%, but I do find this rather interesting that in the fourth quarter, the acceleration in the drop in corporate profits was that dramatic. I mean, just look at the numbers again, right? 60.5 billion decrease. Corporate profits decreased 60.5 billion compared with a decrease of 1.3 in the third quarter. 1.3 to 60. And we have seen these estimates coming down all quarter. So I'll tell you something, first quarter earnings guidance is going to be incredible, and we're 2 weeks away from a bunch of financials leading off our earnings season. Let's look at some other data here. Here is PCE for for February that came out, 2023 for February, and here's our price indexes for PCE 0.3. We can see November 0.2, December 0.2, big jump in January. Even though February is dropped from January 0.3, it's still above the November and December readings. Excluding food and energy, there's the important part, right, is 0.3. You got to go back to November, October, November to get something that low, but 0.3, that is promising. The price indexes, PCE excluding food and energy, 4.6, in line, 4.8, 4.6, 4.7, 4.6, it's in line. If we looked at trimmed means, here we are, this is from the Dallas Fed. We have the 6-month and the 12-month, but not the 3-month. The 3-month is higher than the 6-month and the 12-month if we looked at the trimmed mean. 12-month is 4.6, 6-month is 4.4, 1 month is 4, and I think the 3-month was 4.7 or 4.8. It was higher than the 4.6. Let's go over and look at some regional surveys. This is the Richmond Fed manufacturing activity. You could see from 2021, 2022, 2023, it's just been dropping. Employment, same thing, is just been dropping. Wages kind of holding up when you consider how employment has been moving. This is just a diffusion index. This is growth. This is neither expansion nor contraction, and this is in the contraction area. Manufacturing here has been in contraction for a while. Look at where wages are. This is still growth in wages. This is at zero is neither growth nor contraction. Look at where it is, way up here. And this was pre-pandemic, 2018, 2019, elevated above that. What else do we have here? This is services, service sector revenues in contraction. Employment still in expansion. It's sort of ticking up at the end here. There's wages again, still elevated at that. Price trends are up, still elevated here. Let's go over to Dallas. This is their index here. They break it down into a whole bunch of other categories, but these are the trends, and this is 1 and then a plus. So this is the number of months and the direction that it's going in. New orders, 10 months, negative. Growth rate of orders, 11 months, negative. Unfilled orders are filling sooner. The unfilled orders are dropping. Shipment times are dropping as well. Where are we? Price paid for raw materials, 35 months now, plus. Means expanding. Prices received for finished goods, 32 months, plus. Wages and benefits, 35 months, plus. Well, there's your inflation numbers in there, right? If we look at services, wages and benefits, 34 months, plus. Input prices, 35 months, plus. Selling prices, 32 months, plus. So that is, almost 3 years now with wages and benefits in expansion territory, input prices in expansion territory, selling prices in expansion territory. This was the Dallas Fed manufacturing and services, and we saw the Richmond Fed manufacturing and services. We saw GDP, the trimmed mean, and PCE. Okay, let's look at Nasdaq and S&P now. All right, let's look at QQQ. First thing here we'll do, here is the low, 259.78. Multiply that by 1.2 to get 20% higher. You get to 311.74. So 311.74 was a technical bull market. Anything above 311, we're sitting at 321.35. So Nasdaq is in a technical bull market right now. And with very low volatility. Look at IVP, whether you look at the 13-week, 26 or 52-week, zero percentile, which means over the last year, all observations of implied volatility have been higher. The 20-day at-the-money straddle is 3.96%, which is really low considering the implied volatility for Nasdaq is typically higher than that for S&P. Sitting at 4% is really low. Well, you've had a lot going on in the first quarter. We saw a lot of cost cutting by tech companies. All the big layoffs, 6,000, 10,000, 15,000, all come from the tech industry. You have high labor costs in the economy. Well, that is, the longer that stays, the higher the demand is for technology to replace labor. Don't underestimate momentum. That now that we're in a technical bull market on Nasdaq, that could simply just draw money for no other reason than it's drawing money. So you're going to get momentum chasers coming into this as well. Do not underestimate that. In a low growth environment, tech is desirable as well because, well, you got to cut costs somehow, or you got to increase productivity somehow in low growth. You can't rely on the economy to lift you up. You have to fight for whatever growth in revenues or growth in earnings per share you're going to get. Tech is seen as, a desirable addition in your capex so that you don't have to invest in more people. Plus, tech companies tend to have lower levels of debt, so they're not as sensitive to interest rates as a company with a higher level of debt. If we look at the Nasdaq itself, weightings in the Nasdaq, we say it's a tech heavy industry or tech heavy index. 60% of the weighting comes from technology versus 30% in SPY, twice the weighting of tech, and almost no financials. That's a big deal. So to have no financials in there, and we know the financials have taken a bit of a hit. So if money is leaving the financials, money's got to go somewhere, right? And if money has to stay in equities and money is flowing out of the financial sector, it's got to flow into some other sector. And if we are expecting a low growth environment and labor costs to stay high for a while, tech seems like the natural place that money would go. Although it is rather curious, this is daily fund flows all the way to this is just to the Thursday. We don't have Friday in here. It's just to the Thursday. Wednesday was positive, Thursday was positive, but on the week down 2.826 billion. This was last Friday. Monday had some outflows, Tuesday less, Wednesday, Thursday, and I'm sure when we see Friday's data, it will be higher. This is SPY daily funds flow, negative 4.5 billion. Only Tuesday had some inflows. Wednesday and Thursday did not yet. Squeaked out gains for those days. So I'm interested to see when we get the data. I think this comes out every single day. It's just a day behind in terms of the funds flow. Interesting to see where that is going to end up. Let's look at the commitment of traders as well here. Not a lot of movement going on here. On the long side, 37 contracts down to 14,944. Open interest from the asset manager side is 34%. And this is as of the 28th. So we really don't have the Wednesday, Thursday, and Friday in here. So it doesn't really tell us a lot. This is the thing about some data is just based on how long it takes to compile and get correct. By the time we get it, we already know it, right? And the short side, negative 32 down 10.8, almost no change week over week in Nasdaq. I'm sure when we get it next week, updated for, what would that be, the 4th of April? It is the second, the third. It'll be updated for the 4th. We'll see how Thursday and Friday played out. To know how positioning was on that. So a lot of I think the tech rally wasn't so much because you have a better economy ahead, and not because you have better earnings ahead. We'll see that on the next screen, that earnings and the estimate for earnings are not increasing. It is the multiple expansion that is happening. Because you're getting cost cutting by tech companies, and that cost cutting will add to increased earnings. But more so, it is the idea that, well, if we're going to have a low growth environment with higher labor costs, it is really going to start to pull the demand for tech into companies. And I think a lot of it had to do with AI. And the buzz going on around AI right now. Lots of big headlines in AI last week, and I spent last week trying out a whole bunch of the ones that are available. There are some that will just return text answers to you, some that will draw pictures, just a whole bunch of different ones out there. Here is something interesting I did. I asked ChatGPT to generate Python code to extract live currency quotes from dailyfx.com to put on our site in a table format, so that those people who were buying our packages in US dollars could see the common currency quotes and could do a quick conversion. And it did it in, I think it took 30 seconds, which would have been a couple hours, maybe 2 hours programming from somebody. Did it in 30 seconds. There's the real threat for ChatGPT, isn't stuff like that. For code, it does fairly well. So I wonder, what is the point of the practical skills modules that CFAI is offering in Python coding when you could just get ChatGPT to generate the Python code. Why would you need to do it? I did it in 30 seconds, and I did my computer science undergrad like 20 years ago. So I can read it. I may not know if it's correct, but I can read it and I can look at what it's doing, and it creates the URL. It has the function call, transfers the URL to the function. The function seems like it's calling the right attributes, and then it has code to build a table after in the columns, which one's the bid, which one's the ask. So it was there. So I think that that combined with some of the other headlines we saw last week in AI is really attracting a lot of attention to that in terms of what the promise of this can do. So some of that is wrapped up in this technical bull market that Nasdaq is in. Okay, this chart I got off of LinkedIn. Somebody had put it in their posting. I think it was Muhammad Al-Arian had put it in his posting, and he had thanked somebody else for generating it. It took me a little while to figure out what was going on in here. This is the Nasdaq 100 stock index, BEST, Bloomberg estimate, PE ratio 119. When I looked at it, I said, well, that doesn't seem right. And the estimate of EPS 107 until I saw the normalized as a 1228, so which is this date over here. So all this chart is doing, what this blue line is doing, is it's saying, okay, well, let's say the PE, let's hold the PE ratio constant as of this date. That's what the normalized is, and then the blue line is just the change in what the PE would be, holding it constant. In other words, all you're doing is you're changing the price. So if you're just changing the price and holding the PE constant, the result that you get is the implied earnings per share that would imply. So it's implying earnings per share of 119, and the estimate is at 100.7. So really, what we've seen in the Nasdaq so far is multiple expansion, but not earnings growth, but some earnings growth due to, of course, you're laying off people, you're fixing your bottom line, but there is a limit to how much in EPS you can add from managing your expenses. Typically, if you have an EPS problem, managing your expenses can only get you so far. The biggest return is always managing your revenues, trying to get them higher. So you got a lot of multiple expansion that's happened, and you can see just based on this blue line here, Q1 16.8% on the Nasdaq versus about 7% on the S&P. If we want PE ratios, because this is just the earnings that it implies, because it's normalized, the earnings that would be implied based on the price of the Nasdaq 100 versus the actual or the estimate down here. PE ratios on Nasdaq 100 trailing 12 month is 26.15. A year ago it was 33.54, and the next 12 months the forward multiple is 25.37. I'm not familiar with historical ratios on the Nasdaq, so I couldn't tell you if that was above average or below average on that. But I did find this chart rather interesting, in that earnings really from December 28th to the end of March really have basically gone sideways, although the price is up 16.8%. And that is up not because earnings have done this. That would make sense. If earnings had done that, then that's perfectly justified. You wouldn't question that. You would say, well, that's right on target. It has been purely multiple expansion. Now, this chart does offer some ability for us to sort of determine what the driver of this multiple expansion is, just by looking at where things bottomed and where they topped out. This was the last rally that we had before the Jackson Hole speech, where he said, higher for longer, I don't know what you're thinking, and of course down it went. And then, of course, the end of the year. At the beginning of the year, we had rates that were just dropping in capital market rates, even though the Fed was saying higher for longer. The market was already cutting rates. And it wasn't until February, after the February meeting, when the Fed talk started getting really bearish about, no, 5.5%, 6%. So, of course, this is what happens. But in the last little while, we've had this narrative of, well, the Fed is going to cut rates this year. Remember, we had, 3 rate cuts priced in last week. There's still 2 rate cuts priced in this week. These stocks will be very sensitive to the level of interest rates. So, do they have it right? Well, the Fed has made it very clear that they're not cutting rates. So they have 2 mandates, right? You have full employment and you have price stability. I'm just going to write price stability. Well, you got a check mark over here, but you have an X over here. But, there are signs that the disinflation process has begun. And we do see from the PCE, we do see that it has come down, and it is coming down. Well, let's just do a couple of scenarios. Let's say that inflation comes down to 2%, so that they can check off the price stability box. Well, if you still have full employment and you have both boxes checked, there are your 2 mandates. What's left to do? What would you do? Would you say, well, let's start cutting rates now? We've satisfied both our mandates. We got both boxes checked. Why would you cut rates? You would cut rates to stimulate the economy, but if you're at full employment, why would you even cut rates? So if you're not going to cut rates, then you've got to bring this back down because the cost of capital will be higher for longer. The condition under which rates would be cut is something breaking. Not just the economy slipping into a recession, such that if you got, the real GDP started printing like negative 0.5% for a couple of quarters, if you don't have price stability, rates are going to stay high. If you do have price stability and you still have, let's say, 4%, unemployment goes to 4%, I still don't think the Fed is going to lower rates at that point. They've been very, very clear about that. The only condition under which you're going to get 2 rate cuts this year or more is if something breaks. And if something breaks, then the numerator is too high. Because remember, it's cash flows over your weighted average cost of capital. And that's how you value these things. So either if you want the present values to go up, either your weighted average cost of capital is going down or your cash flows are going up. Well, cash flows are not going up. We can see that, but we do know that weighted average cost of capital has been going down because we did see that at the beginning of the year, and we have seen that most recently. So if we are entering a low growth environment and we do hit into a recession, you're not going to get cash flow growth, but weighted average cost of capital will remain high. The only time you're going to get your weighted average cost of capital to drop really significantly is if something breaks in the economy, and if you get that, then your cash flows will also drop significantly. So if I had to pick what was going on, I think the market has it wrong. I think the price here is correct based on where rates are right now, the level of rates. But I think the market has it wrong on where the level of rates are. If you're expecting a recession and a bad recession, only then will you have a lower weighted average cost of capital, but lower cash flows as well. So I think that the market is trying to have it both ways. It's trying to say, well, cash flows aren't really going anywhere. We have full employment. The economy is strong. However, and interest rates are dropping, inflation is dropping, so the Fed's going to pivot and lower rates. That's the part of the logic that I think is flawed. All of that is true. Okay, cash flows aren't really going anywhere. We do have full employment. We have a strong economy. Inflation does look like it's coming down, period. Fed's not going to cut rates. Fed's not going to cut rates because if you got this box checked and this box will eventually be checked, and your job is done. Why would you do any work in your meetings when both mandates are satisfied? The only time that rates are going to come down, the only time is if full employment is in doubt. You may say, but what if inflation comes all the way down to 2%? Great, then you check both boxes. The only time rates are going to be cut as inflation is coming down, the only condition under which rates would be cut is if if the other mandate then becomes the problem and the bigger problem. And if that is the case, then your numerator is too high. And if that is not the case, then your denominator is too low. Either way, your present value is too high. All right, let's get to SPY. And for some reason, the SP Global spreadsheet is just not updating. It's still saying March 23rd. I don't have the March 30th number. So I'm working blind here today. I'm just going to go with last week's 2/19/16. Closing SPX was 41.08, which puts us at 18.7 times forward earnings. When I look at the commitment of traders, look at the long positions, they've decreased 5,782 contracts, and the short positions have increased 3,619. Both of those are indicating bearish sentiment, but again, this is as of the 28th. I don't have more updated information than that, but as of Tuesday, even after Monday and Tuesday rallies, you had bearish sentiment on the index itself. And when we looked at the flow of funds all the way up to Thursday, Wednesday and Thursday were outflows of funds. June ES 41.39, so there's 30.6 of carry in there. Since it's got a multiple of 50, there's $1,530 of carry. I sold some 4075 calls for June 16th with September as the underlying, and I shorted some September ES. So I added to my negative beta position. And I've said this before, when you're short, you have to be very tactical because the market has a long-only bias. Not only does it have a long-only bias, it is willing to bet money on hope, but it is not as willing to take money off the table if there is just a hint of fear. Even if there is a very real fear, the fear must show up. The data must show up. But the data does not have to show up for hope. Hope can just be a glimmer on the horizon, and markets will go up. So you must be tactical when you're short. The other thing is if you think through, with as least amount of emotion as you can, and with as least amount of confirmation bias as you can, if you think through where the markets are, you have to have the conviction of your belief even if the market works against you. So markets are going up. Can they continue to go up? Probably. But I don't think that it is sustainable, simply because I think the markets have a different story in their head than what the Fed will do, as I explained on the previous screen. That unless something breaks, rates aren't going to get cut. Something did break, but it wasn't credit. Something did break and rates weren't cut. Liquidity was provided, other tools were used, but rates weren't cut. In fact, we're thinking that at the last meeting, we did go up, and we're thinking we'll go up again, even though something did break. Well, unless we have a belief that something significant is going to break, rates aren't going to come down. And if something significant is going to break, these are the wrong prices. Simple as that. So there is no bull market scenario with lower cost of capital. There isn't. So the market has it wrong on rates. It has it wrong on cost of capital. And I'm going to stay with my conviction. Can it get uncomfortable? Yeah, it can get uncomfortable. But, if everything were comfortable all the time, there'd be no return on this market, because it would be crowded, because everyone would say, hey, it's a great place to be. The low on the SPY was 356.60, 20% higher than that is 427.92. So there's your technical bull market up there. We are 4.25% below a technical bull market on the Nasdaq. and sitting at, pushing up 19 times forward earnings on this. IVP, look at the implied volatility here, 13-week 3%, 97% of all the observations were higher than the current 16.1 in the last 13 weeks, from 58th percentile down to the 3rd percentile. 26 weeks from 34 down to 2 and 29 down to 2 on 52. There's just no premium in the options. So that's where we're sitting. We have had a week where we've pretty much just gone straight up. I just don't see it as sustainable, because there's going to be a realization that, given the 2 mandates from the Fed, full employment box is checked, the price stability one isn't, and even if it is checked, if the full employment box is still checked while the price stability box is checked at 5%, at 5.25%, where is the motivation to change anything? At that point, you have found R star, right? You got full employment, check. You got price stability, check. Well, that's R star. R star is the neutral rate, and the neutral rate, R star, on a nominal basis is 5 to 5.25. And if that is the neutral rate at 5 to 5.25, where you have full employment and you have price stability, what has to happen to the cost of capital? What has to happen? It has to go up. And that is going to be a low growth environment when you have a cost of capital that is that high, because most projects will have, that would have had a positive net present value, will now either have a neutral to negative net present value. So that is going to affect capital investment. So at some point it slows down, the momentum in the economy just slows down to the point where is earnings growth? There is no earnings growth. So I can wait. I think I'm right. If rates do suddenly start dropping like mad, is because something happened up here that threatens full employment. Something in credit broke significantly. And I've said this before. If you keep rates high long enough, you will break something. The point is, you don't know when, you don't know where. It'll just be like SVB, where you wake up one day and suddenly it is just there. That's how it happens. It's going to happen. Things like this always happen, but in a low growth environment, they become very threatening, especially when it happens in credit. And it's just a waiting game, because you don't know when, you don't know where, you just know it will, but you just don't know when and where. So I'm going to stay with my position. I'm probably not going to add any more than I have right now, because I do have a significant amount. I do have, thankfully, some long underlyings, so that works out well. But I do think I'll lighten up on some of the long positions as well if we push higher. This, to me, is not a bull market. This is an extended, I think, rally in a bear market, because a lot of confusing things have happened, and I think we've taken our eye off the ball, which is those 2 mandates. One of them is checked, one of them is not checked. And if you get to the other one and you check it while the first one is checked, rates aren't going anywhere. If rates are going down, something is broken. No matter which way you play this game, you either end up with a higher denominator and a lower present value, or a lower numerator and a lower present value. No matter which way I go, I get a lower present value. Let's look at the week ahead. Okay, we have a shortened trading week, but just a normal economic week, because we do have Friday. On Monday, 10 o'clock, ISM for the U.S. You also get S&P Global for both Canada and the U.S., just not as widely followed as the ISM. Also, you get construction spending. When you get into Tuesday, there is your JOLTS, your job openings, and your quit rate, also factory orders. Moving into Wednesday, Canada balance of trade, although I don't know that has much of an effect. I tend to watch the currency whenever these reports come out, and I get nothing. ADP employment change, 8:15. United States, you get balance of trade as well. I don't think that is market moving. 10 o'clock, ISM, non-manufacturing. Difference here, this is still in expansion territory, whereas the ISM manufacturing is in contraction territory, and it's been there for quite some time. Although the non-manufacturing is forecast to come in lower. Keep going into Thursday. You get Canada reporting employment change, and then when the markets are closed, you get Friday at 8:30 the U.S. reporting. Although you can watch the futures to get some idea of how the market is responding to this. I think Globex is open. I think the futures trade till 1 on a holiday day. If it's a Friday, I think they trade till 1, even though the currencies go to 5. There's no action in the currencies past 11 o'clock on a Friday if the U.S. is closed. And both Canada and the U.S. are closed on Friday, so there pretty much is almost no North American session going on. But you should still be able to see how futures are responding on Globex for this one. That's it.